Joining us now on Market Gurus, Chakri Lokapriya, CIO and Managing Director of TCG Advisory Services. Morning, Chakri. Thanks for joining in. Chakri, things have been really good so far. Do you think the markets are in for a bit of a correction now?
I think for coming off the November lows to now, the markets have had a pretty good run up, and also coupled with the rupee appreciation that has happened along the way. And so given this now headed into the earnings season, the rupee appreciation is going to be a headwind for some of the export related sectors, not their own problems notwithstanding. And in addition to that, the mid cap sectors, I think while their earnings growth will be higher than large cap, their valuations are looking quite stretched now at this point in time.
Chakri, the other talking point has been that domestic retail money via mutual funds, has been supporting the market since the start of this year, and that stayed intact as well, apart from, profit taking here and there. Do you see more flows into the market? And as a fund manager, is it getting tougher to find ideas? Because I believe, 200 stocks hit their new lifetime highs in the last 10 days.
They have, but again, if you put things into perspective, the current levels are more or less where they were about a couple of years ago.
That's at the index.
That's at the index level. And if you look at the overall, the mid cap as an index, the PE is about 15 times. FY19, FY18 is not yet a recovery year. And as far as the earnings growth is quite higher than 15%. So from that perspective, they are trading in line with their near-term growth rates. And so therefore, the markets are not as stretched as one would believe. And also coming off the previous lows of the last 3-4 years, they're all coming off very low bases. Still, you haven't seen volume pickup happen. So from that perspective, they have run up quite a bit. But I think some of them will disappoint in the current earnings season. And after that, I think largely it's okay at about 15 times.
By that logic, Chakri, do you feel that there could be a case for large caps to play catch up over here, because mid caps have been outperforming and trading at a significant premium to large caps for a while now? Do you feel that there could be a case for some of that money now flowing into larger cap names, and you could see the benchmark names doing better?
The large cap is fairly tricky in the sense that it's the domestic versus the export. And now going into this year, it's the metals which are doing well. Banks, because they've been in such bad shape, you'll see the strongest earnings recovery. Industrials, which were bad in the last 2-3 years, are beginning to recover. So you have only very select pockets of growth in metals, in industrials and banks, which will largely drive the Nifty earnings growth. Against this backdrop, you won't have a broad-based Nifty, recovery of earnings, but rather it's very, very sector specific.
Right. In fact, let's talk about one of those sectors that are shaping up for earnings, and that's IT. Infosys comes out on Thursday. Gartner slashing 2017 forecast to just about 1.4%. This is for the global IT services industry on the back of a stronger dollar. But in India, the rupee has been appreciating quite smartly, and if it heads towards those 63 levels, it could be a 6-year high. How much of a concern is that for IT companies, along with the usual protectionist talk, as also the fact that Trump is now more reality than rhetoric as far as visa is concerned?
Is more rhetoric than reality, yes. But again, the Indian IT companies have to rejig their business model, hire the higher skilled workers, which they will do offshore in the US. So it helps their business model. There's something they were going to do, thinking of doing, are now forced to do it sooner rather than later. Now, as far as rupee is concerned, yes, it's appreciated 5%. But if you look at, let's say, 2015, rupee is still down 2.5% versus two years ago. So from that perspective, you'll have your near-term FX losses, because IT companies have never been good in hedging cross-currency wins. So from that perspective, this quarter is unlikely to be a strong quarter for Indian IT companies. And as far as their medium-term projections, I think now they are talking about 7-8% revenue growth, about 12-14% EPS growth, which is highly doable.
Chakri, the markets have attempted to scale these highs 3 times in the past. Last 3 times they got to levels of 8,900, couldn't make it because earnings didn't keep up. This is the 4th attempt. We are sitting at 9,000, pretty comfortably 9,100 now. But again, expectations are running very high. Do you think earnings will keep pace with the market this time around?
It's a good question, because in the last couple of years, every time we said that the next year would be better. Various reasons have led that next year to be pushed forward by another year. And last post demonetization, UP elections, which led to some demand drop for companies, you will see a certain amount of earnings recovery that happens in this quarter. If you look at IT companies, for example, demonetization to two-wheeler volumes fell. You'll see some recovery now. But again, that's been hit because of these BS4 emission standards. So something new in the mix keeps coming up. And then the liquor ban on the highways. Now that shaves off about 50-60,000 crores to the industry, a big number. So these kind of unknowns are holding back each time the market is trying to cross a new high. So from that perspective, I think that we are still pretty much range bound. Or longer term, maybe we go up, longer term, i.e. next 1 year, we go up maybe another 5-7%, but at an index level, that's it. But at individual stock level, there'll always be opportunities.
Chakri, it's been a great season for IPOs as well. I mean, you look at Avenue Supermarts, look at Shankara Buildings. These stocks have done exceptionally well, and some of these are niche stories. Do you think these niche stories have the potential to turn out to be, value players going ahead?
I think so, because some of the new IPOs are all, like you rightly mentioned, a niche place. And the IPO pipeline for after a very long time is strengthening up on the back of improving market conditions. While yes, Avenue looks expensive at current levels, it's done phenomenally well from the IPO to now. So from that perspective, the confidence is there among entrepreneurs to go out and do a listing. So we will see a number of new stocks. The pipeline is very strong.
Also, action as far as buybacks are concerned, dividend, or just coming to the markets to raise money, a lot more QIPs. Do you feel that there's enough liquidity, barring everything that we're seeing globally, enough liquidity in the domestic markets, not just to invest, but also participate in this action?
Yes, indeed. And also, if you look at from November 8th to today, that was both the US election as well as India's demonetization day. From then to now, rupee has gone up 5-6%. And as rupee appreciates, or at least shows signs of stabilization, that's when FIIs start coming in. Because otherwise, as an FII, our earnings our portfolio returns get hit on a falling rupee. And a rising rupee is the opposite. You benefit from that. So this rising rupee has rather aided the FII flows. So as long as there is a stability in rupee, which seems to be likely because fiscal deficit, etc., are under control, I think you would continue to see inflows.
If you're going to see inflows, what are the next stage of reforms that FIs would like to see, that investors would like to see? So GST more or less in the bag for now. But on one side, you have the government which is going ahead with loan waivers across different states. So that is going to raise concern as far as government finances are concerned. Also, the fact that you have BJP, which has majority both at the center and select key states. So there is a mandate for them to go ahead and initiate some of those reforms. What is that the markets would like to see?
I think now we've come to a point, the markets have come to the point where at least the FIIs do not expect any major reforms. I mean, GST is a major reform which is now a reality and likely to happen. But other things, I doubt the market is expecting any big bang thing. And in a couple of years, the Modi government goes into an election. So in 1 year from now, you're in election mode in any case. And so from that perspective, I think it's more a cyclical recovery at this point, a mid-cycle recovery, which is key for earnings growth.
Chakri, the other talking point in the market has been the way discretionary consumption has been doing. So stocks like Eicher Motors, Maruti, Bajaj Auto have all hit a fresh high recently. Do you still see value in discretionary spends?
Yes, because again, you rewind back to November of last year, two-wheeler sales fell, car sales to an extent fell. And now they're recovering. Two-wheeler sales have shown modest signs of recovery. Again, you've seen Maruti again with very good numbers. Now, as far as the medium commercial vehicles, some of this BS4 impact will happen. but volume growth will probably be 4-5%. Now, what is likely to get hit in the auto space is the second half of this year as GST is rolled out. The confusion or rather uncertainty until the tax rates are known, GST tax rates are known, you're likely to see a slowdown. As far as the other items, you're going to see what you call things like air conditioners, those kind of smaller ticket items. One, they're dependent on summer, how hot it is, etc. And also, it has been slow in the past quarter, so this quarter is likely to be better.
Chakri, what is driving the move in stocks like in Edelweiss and India Infoline? I mean, do you think this is a reflection of where household money is heading to, which is financial assets, and therefore this could be a niche sector that could be a value creator or a multi-bagger going ahead?
The volumes, partly the volatility in the markets has improved the volumes in the markets, and which has aided to the earnings of these companies as far as the brokerage bit is concerned. And NBFCs today are in a far better shape. Valuations is a different issue right now. The NBFC arms of some of these companies are doing well, and that is also a driving force.
Consequently, you would have thought that realty as an investment theme is losing sheen, but the fact remains that real estate stocks have been on fire this year. So real estate index, the Nifty real estate index is a top performing index. YTD, it's up 35%. A lot of your mid-cap real estate stocks have just shot up through the roof recently. What's the driving factor over here? Because even if you talk about the affordable housing opportunity, A, we're still to see it take off in a big way, and B, not too many listed players are in that space active at the moment. So what's driving real estate at the point?
It's very interesting in terms of when you look at immediately after demonetization, all the stocks fell on expectations that there was going to be subdued sales. But most of the cash component is not there in the apartment sales segment, but rather only it was in land deals. And most of the real estate companies sell apartments where the cash component is not there. And the fear of the demonetization, etc., lasted a couple of months. Turned out that actually sales are picking up of the apartment sales we are talking about in the residential unit. And that led to these stocks rally because they had fallen quite a bit. And as far as commercial real estate is concerned, I think the talk of REITs, when it becomes a reality, will significantly add liquidity to real estate companies because it will help them to deleverage their balance sheet.
Consequently, do you feel there could be traction going forward for the auxiliary plays in this space? So the paint manufacturers, that could be one space that will do well. The building materials space, do you feel that consequently that's where you could get some of those multi-bagger ideas coming in from?
That space will be benefited from both what the government wants to do of housing for all by 2022, as well as a revival in the real estate space. The valuation of some of the sectors, paint companies or the Pidilites of the world, the valuations are a bit steep. So maybe they'll take a breather from a stock run-up perspective, but I think earnings will catch up in the coming quarters.
What about banks, Chakri? I mean, some of these banks like RBL have done phenomenally well in the recent past. It is a stock that most people are very optimistic on despite the kind of run-up we've seen. So I'm not going to talk about that specific counter, but where is the value in the banking space? Is it the PSU banks that are lagging behind? Is it NBFCs that were the darlings of the street till mid of last year? Or is it private sector banks which have already ran up so much, but there is value because there's a price you pay for growth, and there is growth in the likes of an RBL?
I think now where the growth lies, or rather the stock price growth lies in corporate banks, both PSU banks which have a corporate exposure, as well as banks like ICICI, Axis, which have big corporate exposure rather than retail-focused banks. Now, corporate banks, as we know, have gone through these huge NPL issues for well-known reasons: lower profitability, lower margins, low credit growth, all for reasons well known. And now, any normalization in any of this will help, and their valuations are very, very reasonable, the corporate banks. So from the corporate banks, both PSUs as well as the ICIs of the world is I think the space to be in.
Chakri, so while the markets, stocks have all moved up, and you've even seen counters in the infrastructure space doing well, I think one worry that most people have is that capex is not picking up. Is that a concern you have? Is the on-ground reality very different from what is reflected in stock prices right now?
I think there are two things. One is capex will continue to be weak for the next.
And what justifies the rally?
Years.
What justifies the kind of euphoria we're seeing?
Is improvement in operating margins.
Interest costs are not on their way down either.
At least when you higher volumes, higher capacity utilization, higher margins.
So you do think that demand is still getting better?
Demand is getting better. Needs to get better because demand has been very, very weak. Demand has been, in fact, for FY17, largely negative in the industrial space. And not just last year, even the previous year. So when you go from a zero and a minus numbers, anything positive growth is positive growth.
Could this be one of the leaders of the rally going forward? I was speaking to a mid-cap company last week, KC International. Their order book is at an all-time high. For something like an L&T, Jefferies came out with a note recently saying the stock could rally to 2,000 and beyond. Even stocks like BEL, BHEL, Thermax, all of them have been gaining traction of late. Could this be one space that leads the next round of up move?
Yeah, this sector has been the most hit in the last few years for stalled projects, cancelled projects, etc. And now you are seeing a revival in the space, very slow, not as fast as one we thought it would be. But again, when demand turns from negative to positive, the companies with slightly, even the leveraged balance sheet ones, will start benefiting because of the higher volumes.
What's the case for pharma now going forward from here? So those regular concerns remain, and the fact remains that even if you go ahead and buy a quality stock, you know about the management, you know about the research pipeline, you know about the product approval pipeline. Some alert comes from the US FDA, and those 20% gains are just lost in one day of trade. So how do you place your bets within the pharma space? Even quality names like Biocon are susceptible to some kind of volatility going forward because a lot of their plants are up for inspection going forward from here. So how do you identify value in pharma?
I think in the case of pharma, it's just buying the fallen down stocks because what has happened in the case of the US FDA is largely, while company specific, it also reflects an industry phenomena of lax controls in the past. And they're all quickly trying to fix themselves up to meet the higher level of scrutiny of FDA. Against this backdrop, it's almost impossible to say that, which next manufacturing facility will turn out having a few skeletons. So the ones which are fallen or resolving issues would be the place to be.
And within that, mid caps or large caps, where should the preference lie?
Mid caps or large caps, both notwithstanding, I think companies where the inspections are complete, who are now mending their factories, those are the ones to buy. But this quarter,
you never know when a Form 483 an inspection
right.
comes up, right?
Yeah.
I mean, how does one take a call on that?
Yeah, if a factory has a 483, and then the company invariably starts sprucing up its other facilities as well. So then the overall company becomes a safer play. But going into this quarter, I think you will have a 5-6% EPS hit because of rupee appreciation.
I mean, I don't know if you track this. It's a relatively smaller sector, but it's more news-driven today. And I'm talking about alcohol stocks. Not that many in the listed space. I mean, actually, that's not fair to say because you do have United Breweries, United Spirits, Tilak Nagar. Market cap, of course, not being too large of the Tilak Nagars of the world. But what is the future of these companies looking like?
Increasingly, they unfortunately are becoming more politically driven stocks. Big states, Punjab, Tamil Nadu, now Madhya Pradesh, are all talking of various levels of bans, which is a complete, it's a curveball thrown at you never anticipated before. And so now that we are going into election in the next couple of years, you don't know, any number of states will use it as a populist theme. Against that backdrop, I think the earnings outlook, or rather revenue outlook itself, is very uncertain because very difficult to forecast.
Another space that gets impacted by the way the rupee moves, barring, of course, IT and pharma, is textile names. Again, I don't think they've seen those days like they had in the past, and of course the industry dynamics have changed in the last few years. But anything in the textile space that you liked or you did not like, or could have, one could take profit off the table?
Within the textile space, it's actually the export-related ones, which have a significant component of exports, are doing rather well. And you have seen a big
Volumes
are picking up quite strongly, and so that will make up for whatever rupee change that happens. And in fact, some of the textile names are all gearing up for much higher volumes as we head into the Western summer season.
What about oil and gas in that light? Then Chakri, a lot of news in the last few days, so whether it's oil which has rallied to a 5-week high, or the fact that dealers are now possibly talking about not working every Sunday because they're trying to arm twist the government into higher margins, or in fact something like price revision on a dynamic basis, so daily price revision, moving to that kind of a trend. A lot of news happening over there. Any play that you like in the oil and gas space? Another space within that's been buzzing is the city gas distributors. A lot of traction in that as well. Would that interest you?
I think two things. One is dynamic pricing has been the norm in the West for a very long time, and the stocks do well. So as long as these companies adapt to that, that's fine. The volatility in the oil prices, if you look at year-to-date, oil is actually down about 2%, but the volatility has been very high. Because of that, you'll have a huge amount of inventory losses for many of the downstream companies who use various derivatives of crude. When we go into this earnings. On the other hand, margins, refining capacities around the world haven't really expanded because manufacturers have shied away from putting up new plants. So from that perspective, refining margins will be strong, but downstream companies are likely to take an earnings hit as we go into the coming couple of quarters.
So you're saying it's going to be at least Q4 doesn't look like too good for oil and gas?
For the refining company, for somebody like a Reliance Industries, it looks good. But on the other hand, some of the polymer companies, which are users, they'll have a negative earnings hit.
Right. Chakri, very lastly, what has changed between the Nifty at 9,000 in March 2015 versus Nifty at 9,100 in 2017? Is it valuations? Is it sectoral leaders? In your opinion, what is different today than it was 2 years ago?
It's a sector rotation. If you look at the previous 2015, it was domestic, and now it is metals and oil, export-related sectors. Metal earnings are going to go up some 200-odd%. Banks, which was negative 2 years ago, are going to see the positive revisions. So it's the sector rotation which has brought the Nifty up more than broad-based earnings recovery.